Welcome back. This is DMXURE continuing on with an example spreadsheet showing one how to move from statutory accounting to US GAAP accounting for a 10-year term product. Whenever you're doing these types of calculations, there's a very important check that we'll do at the end, and that is to make sure that all the statutory profits are equal to all the GAAP profits when you sum them all up. And so in order to do that, of course, we're going to have to do projected statutory profits for this particular product. This is a very generic type of calculation. Please don't see this as being, perfectly realistic. I'm trying to get the general gist of what's going on here. Well, to start this off here with this projection, the projection always starts with a balance sheet. In this case, all the numbers are 0. We'll go down here and do a bunch of calculations, take those calculations and push them back up in here to the balance sheet. Then we'll go down to do a bunch of calculations and push them back up into the balance sheet. And we'll do that until we get to the very end. The very first part of the projections we'll do is just the population projection here. We're going to be selling 3,000 policies. There's going to be a certain number of deaths, in this case 4.92, based off of our assumptions. Certain number of people are going to lapse out. We get any number of policies and bring this forward and do it all over again. But we will need the number of policies. Now, the number of policies do not go onto the income statement. Income statement, on the other hand, is just going to be like cash flow items and change in reserves. So a cash flow item, of course, is the premiums. That's based off of the number of policies we have here. It's not rocket science. We're going to have investment income, and I'll get to that later. The investment income is actually split into two pieces. It's the investment income on the assets supporting reserves and the investment income on all the other assets. Now, splitting it out into two pieces really makes some analysis better at the end. That's why I'm splitting this out into two pieces. Change in DAC is an item that's being shown here, but it's not really used for statutory accounting. We're going to be using for US GAAP. I want to keep the formats for statutory and GAAP accounting as the same in order to make easier comparisons. Benefit payments and sales expenses, ongoing expenses, hey, just cash flows, it's not hard. We have a change in reserves items here. The change in reserves comes from the balance sheet. So we go up to the balance sheet, you can see the change in reserves. We're going to get a pre-tax profit, then we're going to subtract some taxes. Now, the taxes that we're subtracting off here are not going to be at 21%. We're going to have to figure out amount of profits under a tax basis in order to figure out the taxes. And that's done at the bottom here. I'm going to go down there and do this right here. Basically, what this calculation does is I'm going to remove the change in statutory reserves and put in the change in tax reserves. We get a different pre-tax profit. I'm going to take 21% of that, and that's going to be the taxes that we'll use above. I'm sorry, I'm going to go back down here. Now, early on, the profits using tax reserves are going to be larger. The IRS wants to get their money quicker, so if you put more profits up front rather than at the end, they're going to get their money quicker. In this case, it's 470,000 is the amount of profits in the second year. And if we look up here, the amount of profits on a statutory basis is lower at 454. So we got to roll this all forward, and we might have to put some money in, or we might be able to give some money back to the owners of the company. Now, if you look back at the balance sheet, our beginning net worth was 0. Hey, we're losing a little bit over $1 million here. We want to have a certain amount of money at the end of the year, and the amount of money is called target surplus. That's the amount of money that we want to have at the end of the year because we want to be very certain we're able to make all of our benefit payments. There's a lot of rules for determining how you come up with that number. That will be the subject of a future blog. For right now, we're just going to say we need $1 million here at the end of the period. Well, we lost 1.1 million. We need $1 million at the end of the year. So the owners of the company are going to have to dump in $2.1 million into the product. Uh, you might say that's pretty bad. Well, that's pretty normal actually. Any life insurance product is going to have very, very high selling expenses. It's not very easy to sell the product. It's just the way it is. Those people who sell the products get paid a lot of money because, hey, they're worth it. At least they are for right now until somebody comes up with a better distribution method. But that generally means the loss of the first year, and people have to dump in money during the first year if you own an insurance company. Now we can carry this forward to the next year. We have that ending net worth becomes the beginning net worth. This next year we do make some money, 355,000. Actually, 425,000 can be paid out in this year. And the reason here is the amount of target surplus goes down. Now the safety margin goes down because like 10% of the people lapsed out. So we're going to have some of that go down. So you're going to be able to shell out more money than profits in the second year. Now we have a whole string of money going in and money going out. That actually produces a 12% internal rate of return. You can look up this calculation up here. It's all based off of cash flows. Those cash flows indicate that, hey, if you invest that $2 million up front, that you're going to get a return of 12% on that money that's coming out. I'm going to go back up to the top here. The assets, to get the ending assets, it's just going to be a cash flow basis. And we can look at all the numbers going into it. You take the beginning assets, and then you're going to add in the cash flow items from the income statement. And we also have a cash flow item, which is going to be a shareholder dividend. And we can pull that forward all the way to the end. At the end, we end up with zero because if there's any money left over, we're going to pay it out as a dividend. Actually, all the numbers should end up to zero. Otherwise, there's a mistake in the calculations. Fortunately, I don't see a mistake right now, but it's a good sign. The DAC asset is zero just because it's a GAAP concept. We're not going to use it for statutory. Same with the deferred tax liability. The change in reserves are just the reserves there. We also come up with the net worth being $1 million, a little bit more than that. That's just going to be the assets minus the liabilities. You can see that right there. And one more check just to make sure everything is working. The net worth is calculated as assets minus liabilities. And if you look down here, you can actually get the net worth using a roll forward. But you can see the 1.027 million matches up with the number right here. So hopefully this was helpful just to understand how statutory accounting works for a product. My next video will be covering how to do a statutory reserve calculation. Thank you for watching.